Hello, and welcome to Managerial Accounting. I'm going to quickly go through some key concepts for chapters 1 and 2 during this video lecture. As an introduction to managerial accounting, I want to talk about the differences between financial and managerial accounting. Accounting information is used by internal managers in their day-to-day decision making and also by external users. The key to the difference between financial and managerial accounting is how the information is used. Traditional financial accounting information, which you learned about in 201, is specifically finance related. Assets, liabilities, revenues, gross margin, operating expenses, and the such. Non-financial information is mostly used by internal managers to make decision making within the organization. Here are some examples of quantitative and qualitative information that's non-financial. Just going back to that slide for a second. The key difference between financial and managerial accounting is financial accounting is prepared in accordance with GAAP, which are specific accounting policies and guidelines. They're also prepared for external users, and information is used by internal users as well. Managerial accounting information is specifically prepared for internal users to use for their decision-making processes. This is what we're going to learn about within the next 8 weeks, is how to accumulate this managerial information and then use that information in order to make decisions within an organization. A key concept here is relevant costs. In order to be able to make an appropriate decision, we need to focus on the relevant costs. These are costs that can be avoided by choosing option A versus option B. An example that the book uses here is buying a car with a CD changer versus buying a car without. If you buy a car with a CD changer, it's probably going to be more expensive than if you buy one without. The cost of that CD changer is a relevant cost because it's different between the two options. Sunk costs are historical costs. They've already occurred and they cannot be avoided, and they're totally irrelevant to the decision. An example here is watching a horrible rental movie that's unbearable during its first 20 minutes. The rental fee is a sunk cost. You shouldn't take into consideration that rental fee because you're stuck with it whether or not you watch the movie. A lot of people get hung up here because they think to themselves, well, I've already spent the money and I've already spent 20 minutes watching this. I don't want to waste that, so I'm going to watch the rest of it. Well, you're going to have spent that regardless if you watch the movie or not. Therefore, it shouldn't factor into your decision making when you're talking about a financial decision. Opportunity costs are a benefit that you give up when you choose one option versus the other. An example here is choosing to go to college or working full-time. While you may make money immediately working full-time, you're giving up the future benefit that you will receive of a potential higher salary in the future if you receive a college degree. That's called your opportunity cost. It's that higher salary that you're potentially giving up. Now we move on to chapter 2. Here's where we start to talk about product costing and using different terminology and analysis that we're going to be using later on in the semester for decision-making purposes. We're going to be talking about 3 different types of companies. The concepts that we talk about are all the same for these types of companies. They're just a little bit different in how they're being used. We have our traditional manufacturing company, which takes raw materials and makes products with them. We have a merchandising company, which is basically buying products from another company and then selling them. And then we have a service organization, which doesn't have products that they're selling, but instead has services. Let's talk about the production process. This is typically at a manufacturing company. They go ahead and purchase raw materials and transform them into a finished product. The example that I'm going to talk about in the next video is a furniture company. So the raw material that they're purchasing is the wood that they then do work on in order to make the furniture. The production process requires labor and other costs such as utilities, depreciation, factory equipment, and then the cost of supplies in order to produce the finished goods, or in this case, furniture. There's two different types of costs, manufacturing and non-manufacturing. This is a key concept for Chapter 2 that we're going to be using later on in the semester as well. Manufacturing costs are incurred within the factory or plant, and they're directly related to producing that product. Non-manufacturing costs are typically outside of the plant or factory, and they're categorized as selling or administrative costs. An example of this would be insurance, advertising, marketing costs, accounting, anything back office, and that's not directly associated with making that product, but it's needed in order to make the company run on a day-to-day basis. Again, non-manufacturing costs are not directly incurred by the production of the process. They're also called period costs, and they're immediately expensed on the income statement. Let's look at the cash flows of a traditional manufacturing environment. In the raw materials are used interchangeably with the term direct materials. You need to purchase your raw materials, then you have your labor, and you have your manufacturing overhead. That's your overhead that is related to producing the product, but can't be directly tied to a specific product. Examples are rent on the factory, utilities for the factory, depreciation on the machines. These three types of costs go into your work in process account. This is where you're starting to put the furniture together. Once the furniture is done, it moves to your finished goods account. And once the furniture is ready to be sold, it's going to move into your cost of goods sold account. And when it moves to your cost of goods sold account, that's when it's ready to be expensed on the income statement. While the costs are within your work in process or finished goods account, those are held in inventory accounts in your balance sheet. So here's an example. In the storeroom, you have your raw materials. Typically, you're starting off with something. You purchase additional raw materials. You use those raw materials, and then you have your ending inventory. The raw materials that you used are then transferred over to your work in process account. You're starting with a beginning balance. You add the raw materials that you use from your raw materials account. You're going to add your direct labor and your manufacturing overhead. And then once you have completed those, the sum of those costs are going to be called your cost of goods manufactured. That's what moves into your finished goods account. And then you have your ending inventory. For finished goods, it's going into the finished goods warehouse. You have a beginning inventory account. You have your cost of goods manufactured, which is what came from work in process, and your ending inventory. The difference is your cost of goods sold. That's then moved over to your cost of goods sold account and expensed on the income statement. I'll be showing an example of this in the next video. So there's many similarities between costing of products in a manufacturing company and the costing of services. Typically, instead of cost of goods sold on the income statement, you'll see the term cost of services or cost of revenue. They're going to have a small amount of raw materials, but a large amount of labor and overhead. So just to recap, our product costs are here. They follow the product as the product's produced, and it stays on the balance sheet until they're sold and then get booked to the income statement. Your non-product costs are called your period costs, which is your selling and admin costs, and they get immediately expensed on the income statement. Please refer to the next video that will go through an example for Chapter 2. Thank you.